Right, slight change of direction now. We're going to talk about UK real estate and specifically about Custodian Property Income REIT, but we'll leave plenty of time for questions. I'm happy to answer broader questions about UK commercial real estate. Custodian was launched 11 years ago. It aims to be the REIT of choice for private and institutional investors seeking high and stable dividends from well-diversified UK real estate. And I suppose that says it all. And what I will try and do is sort of unpack that a bit and explain why we do, what we're trying to achieve. But to start, we've got to consider the wider investment landscape. And it's been pretty tough for real estate over the last 2 years. We've had rising interest rates, falling property valuations. There's been a big focus on macroeconomic drivers, and I think that has overlooked the opportunity in real estate. It's the Magnificent Seven that have taken all the headlines. But they're not without their challenges. There's been significant volatility there. Clearly, we have to mention Trump and what's going on with the trade war. And I think what we saw through the last few weeks is fairly extreme volatility in our share price, because I think that along with the rest of the market, there was very little sort of light and shade between people's reactions to Trumponomics. And we saw the share price fall very sharply and then recover very sharply over a 3-week period to be back where it was before he got out his trade war board. And of course, we've seen a market where fixed income has offered some pretty attractive risk return dynamics. And that's been a challenge for real estate, not least because real estate is very closely correlated to 10-year gilt rates. And we've seen those gilt rates rise. I spend a lot of time trying to explain to people why I think now is a good time to buy into UK real estate. But I thought I should get with the programme, get modern, and ask AI what it thought about the problem. And what I discovered, because we're told that AI is a big problem for everyone, we should all be terrified, it's just quite good at regurgitating what other people have said. At least that's what my experience has been thus far. And what it said when I asked ChatGPT why UK REITs are trading at a discount is this. And it gave me 7 reasons why UK REITs might be trading at a discount. And I've split them into 2 columns. The dark blue are issues that I think don't apply. The property market is not suffering challenges. In fact, it's been very strong. We're seeing strong rental growth in all sectors of the property market. We're seeing property values recovering, and that recovery started in the middle of last year. Interest rates are falling. That's always good for real estate. Someone said the other day, it's property's dirty little secret. I don't think it's a dirty little secret. I think we're very clear about it. We like interest rates falling. It's very good for real estate. It suggests that the dividend cuts might be a problem, and they would be if indeed we were expecting to see dividend cuts. But actually, certainly in our case and more broadly across the sector, our dividends are fully covered by earnings, and we don't see that changing. So then to the light blue, and this we have got a couple of issues here. Clearly, economic uncertainty in the market is prevalent, and I think that will settle down, but exactly when I don't know, and that is certainly influencing people's sentiment generally towards any form of investment. But the big one, from my perspective, is supply and demand imbalances. Now, the listed real estate market is not all about institutional investment, but when they are out of the market, there is a big gap on the demand side of the equation. And that has seen discounts widen. There was a report out just this week saying that demand for direct real estate, and of course very closely linked to listed real estate, from institutional investors was at a 16-year low in the last quarter. So they've got the off switch on real estate investment at the moment, and that has created these widening discounts, which of course in itself creates a huge opportunity for savvy investors. I mentioned 10-year gilts, and you can see in this chart the very near perfect correlation between 10-year gilts and UK-listed real estate. The aptly titled FTSE EPRA UK REIT Index, which is in reverse, the National Association of Real Estate Investment Trusts, UK. EPRA is a European Real Estate Association, and you all know what the FTSE is. So it's basically the benchmark index for listed UK real estate. And you can't hide from that correlation. Now, the forecasts I have here, and forgive me, all these numbers in this presentation relate to quarter ending December. Watch closely, because we will announce our next quarter's results in the next couple of weeks. So if I've managed to inspire you at all, you might look out for that announcement when it comes. But the forecasts in the early part of the year were that we could see 10-year gilts at 4% by the year end. Now, if that's the case, given this correlation, that's clearly very good for listed real estate. But I think we've got to expect that long-term gilt rates are going to stay a little bit higher than we've been used to over the last 15 years. That's not headline news. I think we all know that. So we shouldn't be expecting significant performance driven by yield compression, which has been the game in real estate through the last couple of cycles. I think, at least I hope, we might have some good old-fashioned common sense and see values grow in line with rental growth. But the good news is that rents are growing. Short term, we do expect to see interest rates fall, and this is the forward curve for SONIA, which you'll be very familiar with, and all very promising for real estate. This chart looks at forecast total return, and it's a forecast that has been put together by the Investment Property Forum. It's a consensus forecast of the great and the good of commercial real estate, be they investors, institutions, advisors, and it is regularly recut. These were from early part of this year, end of last year, November last year. But looking forwards for 2025 and 2026, 8.5% total return from real estate. What is telling and is so important is that consistent income return, which is really why you should invest in real estate, for that long-term, consistent compound income return. But really positive forecasts from those that you would hope are in the know. So that's the bit of scene setting. A little bit more about Custodian. I again resorted to ChatGPT to ask the killer question: why should I invest in Custodian Property Income REIT? Because I've got a pretty good idea why, and I wanted to know what others thought. And I thought it was pretty accurate. You should invest because ours is a diversified portfolio. Diversification mitigates risk. Now, through the last 5 years or so, probably 10 years, the fashion has been for single sector property funds. And people start to call them pure play funds, as that is somehow obfuscating what's actually going on. I have no problem with single sector funds, but let's be honest and call them what they are. They're high risk funds, but they can also deliver high returns. And we've seen that particularly in logistics funds. High risk, high return, but shopping centres have also been a pure play fund. High risk, really bad returns. So a diversified fund is very specifically there to mitigate risk. Someone was kind enough to say that it's professionally managed. Thank you very much, I'll take that. Liquidity is pretty good, it's on the main market. Average daily trading volumes of over 500,000 shares. It's tax efficient because it's a real estate investment trust, so there's no tax at the corporate level, and shareholders pay largely income tax and a bit of property income distribution on PID on dividends. Stable income, absolutely true. A hedge against inflation. Now, this is something that's often talked about with the real estate, and the question is asked, well, is it really a hedge against inflation? And I would say, yes, it is. And we can see it absolutely writ large at the moment with the rental growth that is following a period of inflation. But of course, it lags. It does not match inflation quarter on quarter, but over a longer period, the real value of assets, and the clue's in the name, isn't it? It's real estate, maintains its value, and I think it is a good hedge against inflation. Yet all of this is being overlooked. And you only have to see the wide discounts. The average discount for the UK listed property sector is somewhere between 25 and 30% discount to net asset value. Yet we're seeing all these strongly positive signals. Our portfolio is a little bit unlike others in the market. I know every fund manager likes to tell you that they've somehow got a unique position. And I wouldn't claim that. We are all invested in the same market. We are all exposed to the same macro pressures. But our portfolio is unusual in that we focus on smaller regional properties. And when I say smaller, I'm not talking about workshops under the arches or corner shops. I'm talking about mainstream commercial properties, but typically with a lot size of under 10 million. And that means, of course, we are necessarily more diverse with over 150 properties, over 300 tenancies. We pay, as I said before, a fully covered dividend of 6 pence per share. But because of the discount, at the point of writing this, we were 8.1% dividend yield. Happily, someone has heeded some of my advice, and the share price has picked up a little bit recently. So dividend yield today, 7.7%, but still a very attractive entry point and a great time to invest in real estate when valuations have bottomed out. They bottomed out in 2024. We've started to see through the last 2 quarters a return to valuation growth. And if you can lock in that 7.75% dividend yield today, then the long-term compounding effect of that are very strong. And in terms of rental growth, just to put some numbers on it, the passing rent from the portfolio, 44 million against an estimated rental value. So the rental value of the entire portfolio, if we relet it today, of 49 million. So that's an 11% reversion. So pretty positive. And you can see the rental growth in this chart. What we're looking at in the light blue line is that reversion, the difference between the passing rent and the total estimated rental value of the portfolio. You can see how that rental growth really started to build into the portfolio from about 2020 to sit at 11% today. You shouldn't be worried that that line has peaked and has started to come down because, of course, as we have reached lease renewals and rent reviews, so we've picked up that rental growth, and you can see in the bars how the rent roll of the portfolio has grown. Quarterly rental growth of about 1.4%, that's over 5% per annum over the last couple of years. Occupancy levels have been rising, and LTV has been falling as we've sold 1 or 2 properties at a profit to valuation to bring down the variable rate debt, which was the only relatively expensive part of the debt. You can see here that the property market isn't just about industrial and logistics, and you could have been forgiven for thinking that was the case over the last little while. In fact, at the moment, the most positive news is coming from the office sector, and I think that is contrary to what everyone would have believed and what most of the press have been saying over the last few years. But some really strongly positive news coming out of the office sector. And if we look in our portfolio, a couple of examples of really strong rental growth at lease renewal in Oxford and in Leeds. On the industrial, yes, of course, this is where we've seen the greatest rental growth, and even on the high street, but in the right towns. We have been selling out of small market towns. We have retained those big sort of cathedral city, particularly if they're university cities, high tourist footfall cities, but we've sold out of the small market towns. We have been selling out of out-of-town business park offices, where again, we don't see rental growth, certainly not the sort of growth we've seen in cities like Oxford and Leeds, and recently sold 2 properties in South Manchester ahead of valuation, which was pleasing, but there was some stubborn vacancy in one of those buildings, and we couldn't see the rental growth potential. I think the sector to watch, and certainly if you were to look under the skin of that Investment Property Forum forecast and looked at the sector forecasts, is retail warehousing, out-of-town retail parks. It goes under various names, but or the Americans would call it big box retail, because there is a sector that has strong tenant demand. As consumers, we all like to drive to the shops, park for free, do our shopping, and come home without having to deal with a multi-storey car park and carrying your shopping, getting parking tickets, and all the other nasties that are involved in getting into the city centres. It is a sector that is heavily supply restricted. That, most local authorities now will fight planning applications for out-of-town retail because, of course, it competes directly with their town centres. So supply restricted, strong demand, consumers like it, and we've seen some really strong capital value growth through the early part of this year, and I think rents will follow. Our portfolio is made up like this. This is the split of the portfolio by income. That's important to us. I'll give you the numbers by value. They don't vary wildly. But we are most focused on industrial and logistics and retail warehousing, because that's where we see the most rental growth. And we are retaining, as I said, our city centre offices and a little bit of high street, but it's not significant. The spread of the portfolio is, as you can see here, very diverse. Outside the M25, typically, with the exception of 2 properties, for those of you with a keen eye. And if you can tell me where they are, I'll get you a cup of coffee afterwards. But by and large, we're outside the M25, and that's for a very particular reason. Because we're an income-focused fund, if we can buy in areas where there is less demand from investors, but still the same occupier dynamics, which are driving rental growth, then that suits our strategy. And in terms of diversification, I think this is a chart that almost no other fund could put up. And this is the split of income across our tenants. And what it shows you is that there is no one tenant in any single building that represents more than 1.5% of the rent roll, because even amongst those larger slices of the pie, we have Menzies, for example, Menzies distribution in 8 locations, Wickes in 3 or 4. So there is further diversification within that. So very, very stable cash flows. And I really put this chart up just to defend a challenge that I've had levelled at me far too often, which is that if you've got all these smaller properties across the UK, then presumably you've got significant tenant risk. You've just got weaker, smaller tenants, and it's simply not true. This is Experian credit rating of all our tenants that shows that 84% are considered lower than average risk. So good quality income, well diversified, supporting growing earnings that are fully covering the dividends. It's a pretty, I think, intoxicating mix. And you can see here the blue bar, which is our earnings, against they're both blue. The light blue is earnings. The dark blue is dividends, always covered. But you might ask the question, you perhaps should ask the question, what happened in 2020-21? Well, of course, we all know what happened then. Global pandemic. One of the first legislative reactions was the government saying tenants didn't have to pay rent in that given year. They weren't let off the rent, but they didn't have to pay it there and then. So we didn't know whether we were going to get rent. We didn't know how long it was going to go on. As it turned out, we collected 92% of the rent in the depths of COVID that was due, and the vast majority we collected on payment plans thereafter. But we moved from paying earnings out, dividends out of earnings to paying it out of cash receipt, with the expectation that we'd grow the dividends as we came out of COVID. Of course, as we started to come out of that, then so we started to see interest rates rise, which squeezed earnings a bit. But nevertheless, we've been able to grow the dividend at nearly 5% per annum since then to stand at 6 pence per share today. So why do we do what we do? I've talked a lot about income, and I've talked a little bit about geography and why we buy where we buy. But this chart really sits at the heart of our strategy. If anyone who's heard me before will have heard me talk about this, because it really explains why we can be bothered to buy a large portfolio of smaller properties spread across the country and manage them. And what it shows is transaction yield of properties sold in the market. It's whole market data going back to 2000. The dark blue line represents properties that have a lot size of under 10 million, and the light blue lot sizes of over 10 million. And from 2000 to 2010, you can see there was a very consistent and pretty narrow margin of about 65 basis points. And that's because at the time, all investors were largely agnostic about lot size. It was all about quality of property, and lot size wasn't an issue. But post-2010, the vast majority of investors in the market were pursuing a different strategy, partly driven by the low cost of debt, partly driven by the need for liquidity. And they took a look at the market and asked themselves, what is the most liquid sector of the market? And the answer they came up with was relatively prime, relatively large assets. The reason they considered them to be more liquid is because they were all buying them. And had we got to a situation they all not needed to sell, we might have found that unwind. So what we're not looking at is a change in the risk profile of those smaller regional properties. We're looking at a change in supply and demand. And that supply and demand change has grown that margin to 150 basis points on average. So from 65 to 165 to 150 with no change in the risk profile. So I would say that we're getting somewhere between 90 and 100 basis points of margin for taking no additional risk. That means we can pay a higher dividend, and it is dividends and income that drive 75 to 80% of total return from real estate. So that feels like the right place to focus. One of the other benefits of our strategy is that higher income return means we're much more resilient to changes in interest rates. And that's what this chart is trying to show you. In the light blue, our weighted average cost of debt. 80% of our debt is fixed, but the variable rate debt increased in cost from the early part of 2022, which you can see there, taking us up and then back down more recently to a weighted average cost of debt of 3.9%. And we've charted that against the initial yield of the portfolio in dark blue and the reversionary potential of the grey on top. So you can still see there's a very healthy margin over the cost of debt because we are running that higher yielding property strategy. In terms of debt, we have 4 tranches of debt. The 3 are fixed rate, and then we have a revolving credit facility with Lloyds, which is the second tranche you can see there. The £20 million facility from SWIP expires later this summer. The expectation is that we will take that into our revolving credit facility. Fixed rate debt is still getting a little bit cheaper, but we don't think it's the right time to fix that now, and we have the capacity to do that. And after 10 years of trading, we decided we should look back, because we've never benchmarked the fund. We've always taken the view that it's about absolute return. And I always think it's a little bit disappointing when fund managers crow about their fabulous relative performance when they've still lost shareholders' money, because it's about absolute return. So we looked at our absolute share price total return and charted it against the index, which, as you know from earlier, is the FTSE EPRA NARI UK index, and that's the light-coloured line at the bottom. And it's a pretty miserable showing, actually, but this is to the bottom of the market. You know, let's not forget, this is we've hit a turning point in values. We're seeing the rental growth, but it's to the bottom of the market. And over that 10-year period, the benchmark delivered a positive 6% return. And Custodian REIT over the same period, positive 29%. Happily, it's a little bit better than that following recent share price movements. But we all operate in the same market. So how have we delivered a higher total return than the benchmark? The answer is that, stock selection aside, we've all seen values rise and we've all seen values fall. And there's been no explicit performance just through yield compression. But each and every year, we've paid a higher dividend. And it's that higher dividend that is supported by everything we've been talking about, by the property strategy, the debt strategy, the diversified strategy, that has delivered that outperformance. So I think there are reasons to be cheerful. Great time to get into the market. You can lock into that high dividend yield. 10-year gilt rates are expected to ease a little, but short-term interest rates should fall through this year. The direct market, underlying property market, has already turned. We're seeing property valuations rise, but the listed sector hasn't really reacted to that yet, so the window is still open. And buying in at a 20% discount, I think we're around 17, 18 today, you've got a significant buffer in pricing because those discounts are so wide. So I commend Custodian Property Income REIT to all of you. Any questions?
Thank you.
Don't forget to read that.
Do you really seriously believe that interest rates are going to fall? I don't think the Federal Reserve is going to reduce interest rates in the present situation. And it seems to me that with Donald Trump in charge, there is going to be considerable uncertainty. So interest rates may fall, but if they do fall, it's because he's going to create a recession.
To answer your first question, do I seriously believe? I wouldn't claim to be clever enough to know the answer to that, but based on what other people have said, the consensus is, and you can see it in the forward curve for Sonia, that interest rates will fall. Now, I'm not saying that's right, but that's what the forward curve suggests. And if they do fall, it's good for real estate. And if we have a recession and interest rates fall, it doesn't change the fact that that's good for real estate. Of course, the concerns of recession is wholesale tenant default, but we've never experienced that. And working as I have through a number of recessions, some bigger than others, wholesale tenant default isn't the experience of real estate.
I noted in your penultimate chart that the black line, which I assumed was yours,
Yeah.
outperformed seriously during 2020 and early 2021. Was that the time when you were collecting all your rent rather unexpectedly?
No, it wasn't a rent collection thing. We just saw less volatility. What happened in a lot of the other stocks is they became massively overpriced. And if we go back a couple of slides further to look at this, our sort of core strategy, if we look at the volatility in the larger lot sizes in the 3 years to the end of 2024, it was 29% and we saw 15%. So we saw much less volatility, and it was a big collapse in some of the biggest stock prices that led to that underperformance in the larger funds. And this is partly because, and this is why this is a really interesting audience, because institutional investors, who I've said are not really in the market, and some of the larger investors, in my experience, are fixated on liquidity and cost. And investment should be about risk and return. So there's a real opportunity, while they're all looking the other way and fearing the compliance officer wandering into their office, to take advantage of the mispricing that's being caused by that pursuit of liquidity. So the larger stocks just see greater volatility and significantly lower dividend yields, but they're fundamentally taking the same risks.
Thank you very much. I half believe you.
Hi. I don't think we've seen yet the full impact of the rise in NI on the retail sector. Are you seeing any stress in your rentals in the retail sector? Any pushback on rent increases created by the...
Well, no, we haven't.
No.
And I think you're right. But I think it will be particularly the case for hospitality.
Yeah.
For retail warehousing, which is the majority of our retail exposure, these are large format stores. They operate on pretty low rents. In truth, the retailers did a number on the property sector in COVID. And they all said, oh, this is really tough. We can't trade. These guys, the likes of B&Q, had queues around the block. They were open throughout COVID, but they managed to convince everyone that they needed lower rents. So rents are really low, and they make up a tiny proportion of their costs of operation. So I don't think it'll be the occupier, the landlords that they get hit first. I think staff numbers will suffer. But no, we haven't seen that yet. But I think we could well.
Thank you.
Thank you. Further? Yes.
Could I ask what your average leasehold length would be?
Yeah, it's just under 5 years.
5 years.
Yeah, it's a number we always used to report because our broker said it's really important. People want to know. I said, why are you reporting it? It's not an important number. We've got over 300 tenancies. I mean, leases coming to an end is just everyday life for us. It's what we expect. And actually, it's often when the lease comes to an end, that's when you have the opportunity to push on the rent, to invest in the building. So we don't fear short leases. And in fact, what it means is, as an investor, you are buying the property much closer to its vacant possession value than if you buy properties let on very long leases, which tend to be overvalued because there's too much value in the lease, which is the fastest depreciating part of the entire building. The lease gets shorter every day, obviously.
Do you have to put much expenditure into things like solar?
It's not a question of have to. We've chosen to for two reasons. Firstly, because tenants like it, so they're more likely to lease the buildings. Secondly, because where we've invested in solar, we agree what's called a power purchase agreement with the occupier. So they buy the electricity from us. We give them a discount to the market rate for electricity. But we get, in the last quarter alone, we got 100 grand of solar income from 10 arrays that we have on industrial buildings. We've got another 12 in the pipeline. So we invest in it because that's good business, and it makes the properties more attractive.
Okay. Thank you. Anything online, Paulina? No. So a couple of questions from me. You talked about discounts, but I think discounts are not specific to the sector. They're industry wide, specifically around investment trust, and that has brought in attention from Saba Capital and Bose Weinstein. Firstly, has he been knocking on your door? Is he looking at closing discounts through shareholder activism? Or?
I haven't had any contact at all.
Okay, but secondly, well, and second related question: do you regard yourselves as being at sufficient scale, or does it require more scale to make this business function?
I think scale is certainly popular, and as I said, it's certainly popular amongst institutional investors. But we've got to be very careful in the pursuit of scale that we don't throw the baby out with the bathwater, because as we see these funds grow, so we see that the larger funds tend to have lower dividends, and it's the dividend that drives the lion's share of total return. So we don't want to see all these funds go, particularly because we have seen quite rightly the death of the property unit trust over the last few years, and that needed to happen. Mark Carney, the very successful Mark Carney, when he was governor of Bank of England, he was perhaps less successful, but certainly he made a comment that I agreed with, is that these property unit trusts, were built on a lie, that liquidity lie. So as they have gone, of course, they were very popular with retail investors, and retail investors, in my view, need diversified funds. Not all of them will be as well informed as this audience, and won't know when to get into one specialist sector and out of another specialist sector. So I think there's a real place for the diversified funds, but it can't all be about land securities and British land. So are we big enough? Probably. Would we like to be bigger? Certainly. And we've tried. We tried to merge with Aberdeen Property Income last year. That didn't happen, but we tried very hard.
Okay. And those property unit trusts, some of that capital and some of the managers are moving into LTAF space.
Yeah,
which is another flawed structure.
I'm glad you said that. It is in my view, completely flawed for real estate, because 180-day notice, you just about get the sales brochure ready in 180 days. You certainly wouldn't have, you might not have agreed terms, you certainly wouldn't have done the deal. So it doesn't fix the liquidity problem that it intends to.
But it does compete for that retail investment.
Well, it does, except there aren't really any real estate LTAFs yet. I think there might be one, but it doesn't seem to be put together with any real conviction.
Okay, and we're starting to see, and I think we're sort of sniffing a regulatory push in that direction in some cases. We're starting to see trusts, investment trusts, look at relisting as commercial operating companies, pushing you into a space where, first of all, there's no restriction on leverage. Secondly, there's no issue about further share price issues at discount and so on and so forth. Obviously, set against that, you lose the tax benefit that you spoke about. But is that something that you think about?
You wouldn't lose. You can still be a real estate investment trust and be an operating company rather than an investment trust. Great Portland, Land Securities, British Land, they all have real estate investment trust tax status, but they're not investment trusts. So we've all tied ourselves up with bad nomenclature. A real estate investment trust is a tax status. It doesn't mean necessarily you are an investment trust.
Okay, but so moving.
But in answer to your question, yes, I think that would be hugely beneficial, because for too long, net asset value has been the accepted measure of worth for real estate. And it's what the properties could have been sold for in a hypothetical scenario if you'd started marketing them 3 months ago and if you sold them all individually, because that's what a red book valuation, that's what the valuers have to opine on. But it's not telling you what market price is. It's not forward-looking. It's backwards-looking. And because people have convinced themselves that net asset value is the true measure of worth. If you say, I want to issue shares at below net asset value, they say, oh, that's dilutive, we're not having that. And mathematically, they might be right. But if you could raise money at a time where you could then buy property that was accretive to earnings, so you could pay higher dividends, question, is that good for shareholders? I'm happy to give you my answer. Yes, I think it is. Strongly positive for shareholders. But the investment trust structure precludes you from doing that.
Yes, it's something that the industry hasn't resolved and perhaps needs to, because I think there's a degree of existential risk at the moment.
Yeah.
Okay, if there are no further questions, nothing online, then I'm going to say, Richard, thank you very much indeed. Very interesting.